Computer. All right. So summarizing part of what we covered in the class was the whole idea of um, remember the money slide from the first 5 weeks? The money slide was creating a culture of honesty and eliminating fraud opportunities. So one part of the money slide was all about trying to deal with the psychology of the pressure for fraud and also the rationalization. And then cutting out the opportunities for fraud was really directly targeting the other part of the triangle, and that is eliminating fraud opportunities. That was the first money slide. Well, guess what? There is a second money slide, and I'm so excited. And here is the second money slide, and that is the vulnerability chart. This is something you have to know very, very well, and I'm sure to put this something like this in the exam somewhere, somehow, that you really need to have a sense of if you've done the fraud detection, which was really based on symptoms, A, B, C, D, E, F, G, A, the B, the C, the D, the E, and F. And these are all the symptoms of the fraud. Now we go to investigation. Now we need to start documenting. Well, we've gone past that preponderance of evidence to know that fraud has occurred, right? So therefore, we are interested in, let's just have a look. We're we've gone from fraud detection to fraud investigation, and it's we're beyond a reasonable belief that fraud has occurred. Now we want to find out who committed the fraud, how was it committed. Like at the detection stage, we're just gathering symptoms, right? But once we get to fraud investigation, you need to document stuff out. You cannot just have a hunch that, oh, so and so is the perpetrator, and let's go ask that person. That will be the last thing you do. You've got to circle the wagons around the likely perpetrator and get evidence from other sources first. And the vulnerability chart is a way of helping you to structure your evidence collection. What was taken, who had the opportunity, how were assets moved, how was theft concealed, how are assets converted, red flag symptoms, and possible motives and rationalizations, and any vulnerabilities in terms of internal controls that were strong or weak. And so guess what? This vulnerability chart is the second money slide. And what do I mean by that? Well, the first money slide is the one that will make you money as a consultant when you are trying to help companies shore up their systems or put systems in place to prevent fraud. So what's this money slide about? Well, this is the money slide for when fraud has occurred. And then you're brought in to investigate. Well, you need to start filling out something like this. And of course, there'll be more rows and more rows and rows and rows. But this is just a way of logically setting out the evidence. So even before you go and interview the perpetrator directly, you are gathering as much evidence as you can. And that's when I saw this table 7.1, I'm thinking, yes, that's it. This is the second money slide that you need. If there's 2 slides in this whole unit that you can take away. If someone asks, oh, you did O'Connor's forensic accounting unit. Oh, what did he teach you? He said, oh, 2 slides. 2 slides? You spent 12 weeks and he just gave you 2 slides. I said, yeah, but those 2 slides are so valuable. And you know, the money slide, the first one, is so valuable. We learnt that in the first 4 weeks. This one, again, is got tons of value in its simplicity and the structuring of the evidence that you need to go through when you are investigating fraud. So that's why I call this the second money slide. And if I find a third one, I'll let you know. But remember, money slides are not an ordinary slide, all right? A money slide is something that, wow, you can base your whole consulting career on 1 or 2 slides. Here are these slides. Okay. All right. And so, what we looked at earlier was the money slide, the symptoms of fraud detection. It was all about getting that predication. And then once we go to investigation, then that's why we need the second money slide here. All right. And so if we talk about conversion investigation methods, the big idea I want you to take away this week, and we call this week 6. And I think the big takeaway is this notion of the net worth method. And that is, can we remember what we're doing these past 2 weeks? We're looking at the Theft Act, we're looking at the conversion, and we're looking at concealment. Well, last week we looked at the Theft Act, and we're looking at conversion. With the Theft Act, we're really looking at symptoms. With the conversion, we're really digging into the data to see how money was taken, or how was it concealed, right? All right. This week we're looking at conversion, and in other words, ultimately, when you commit a fraud, you want to convert it into what you spend your life on. So the net effect is that you're going to get a lifestyle change as a result of the fraud that you're undertaking. You're not going to undertake fraud if your lifestyle doesn't change. Did you buy a new car? Did you buy a new boat? Have you got a mansion? Like, are you going on expensive travel trips and things like that? Well, yes. So you can go and look for these things through social media. You can go and look through things by inquiring with travel agents as to, what was the likelihood of expenditure. If you're going over to Europe for 2 weeks on a holiday and business class and whatever, how much would that have been? Or you can go to property real estate agents to find out, how much this house is worth. You now go online to find out how much any house is worth across Australia because of Domain and realestate.com. The information is there. So you can actually find out the actual cost of the lifestyle of potential fraudsters or alleged fraudsters. But this net worth method is an accounting method, and the whole idea is to actually take the change in the balance sheet from period 1 and period 2, and then you compare that change with how much income came in during that period. So if, for example, my net worth went up $500,000 from year 1 to year 2, but I'm only earning $200,000 a year, then what this method finds out is that, there is a gap of $300,000 that kind of, where did that come from? Like, you only earned 2/5 of that change in your net worth. Like, you know, we're discounting capital gains here, all right? House prices go up over time, but we're talking about if you've done an extension on your house, or you just bought a house, or there's a specific asset change. You bought a boat, you bought a car. These all add on to your net worth change, right? So we're not just talking about capital gains changes, all right? We're actually talking about lifestyle changes. You've gone out and bought something, you've gone out and traveled, right? And so a $500,000 change in net worth. Did you earn $500,000 in salary? No, you didn't. You only earned 2/5 of that, $200,000. So where did the $300,000 come from? And then that's the question, isn't it? Did you win it through gambling? Did you win Tats Lotto? Did you sell something that you didn't declare before? Or did you get it from fraud? And that's what the net worth method is all about. And there's a formula in the textbook and how it's worked out. And here's the formula here. And that's just something that you're going to have to work out. And so, we can look at Helen Weeks and how her net worth changed from year 1 to year 2 to year 3. And then, we can add all of this up: 130, 150, 200, 206. And then you've got 100,000 liabilities. So it's 106,000 here. But if we add up in year 2, now we've got 130, 150, 200, 212, 262. And so you got the 206, wait a minute, 130, 150, 212 minus 50. So it's 162. So it's gone from 106 to 162, right? So it's basically gone up, what,
56,000.
56,000, good. But your salary was 40,000. So there's 16,000 kind of difference. But actually, when you take out the expenses and mortgage payments and other living expenses, you got 40,000 here. You take off 30,800. You've only got 30,800 or 40 at $19,200 of that 56,000 as accounted for by your income. You're with me here. So what about the other $30,800? You see what I mean? And that's the net worth method. And then you can do that from year 2 to year 3. You add up the net change from year 2 to 3, and you adjust it with the salary, which is the same, only $2,000 more, 42,000, less all the living expenses. And you'll see that, wow, how can they pay off that $50,000 mortgage? It's so strange, isn't it? How can, stocks and bonds, did they buy them? Automobiles, they've afforded another automobile, $20,000 to $40,000. Cars don't appreciate, you know what I mean? They always depreciate. Houses might go up, but not cars. And so you get the message. And so the whole idea is right at the bottom, there's going to be an amount that will, where did it get the money for that? And that's what the net worth method. And that's why if you look on the next slide, then you can see that the net worth has changed, all right, from 106 to 162, 162 to 246. But really, the salary to meet that is nearly impossible, because the total income is change in net worth. I don't know why. The way they do it is kind of, you can do it any way you like, but the most important thing is that the income from unknown sources is 46,800 in the year 2, and year 3, 74,800. So you're even in worse off, all right? So that's what we mean by the net worth. So I just want to remind you that don't the mistakes that students make when they're doing these calculations is they look, the idea is you only calculate the change in net assets, right? So assets minus liabilities. You don't calculate the change in income. That's the biggest advice I give you, right? Because income is change in itself. You with me? But assets from year 1 to year 2, it's a change. You with me? And so sometimes students go, oh, they calculate this change from year 2 to year 3. Oh, income only went up $2,000. No, you don't do that. You only do the change on the balance sheet items. You don't do change on income and expense items. So just make a note of that. That's where the students make most of the mistakes in this calculation. And at the end of the day, you can do it this way or you can do it my way. That is, I just did the calculation. I did the income and expenses separately from the change, and then I looked at the difference. And so at the end of the day, if we're grading the exam, what matters is that you get to this figure here, income from unknown sources. Okay, how you get there, you can go this way or you can go the other way that I talked about. So the main thing is that it's clear and logical and you make things very clear. So that's the big idea from week 6. All right. And that's what I want you to take away. Remember, I'd like to put something like this in the exam. It's the first part of the accounting. There's case 1. I'll put the solutions into the LMS so you can dig them out, and do go through them. And I think they'll help you a lot. What I want you to do now is, can I ask you to scan this QR code? And yeah, did you want, I know we can, I think we should play Kahoot. Do you want to play Kahoot? Yes or no?
I'd love to.
Yes.
Yeah.
Yeah, we love our Kahoot. Let's just see if we can get it working out. We love our Kahoot. Let's just see what we've got. Log in. I'm just, while we're here, we're going to pause recording. Stop